most people seem to just not really accept the fact that we're not going back to 0% interest rates. We're not going back to sub 2% inflation. And we're probably, I don't see any way that we're going back to any semblance of a reasonable deficit going forward. And so the playbook is extremely different today than it was pre 2020. But again, a lot of capital assets aren't priced for that.
Very pleased to welcome to Monetary Matters James Davolos, Portfolio Manager of Horizon Kinetics. James, great to see you. How have you been?
I've been great, Jack. Really happy to be back on your show.
I'm very pleased to see you, James. You are a portfolio manager of the of Horizon Kinetics Inflation's Beneficiaries Fund, the ETF. And so we first spoke when that fund launched 3 years ago. I want to ask you, back then it was the beginnings, the early innings of an inflationary wave. Obviously, we had a huge inflationary boom in 2022 that our economy, our citizens are still dealing with. What's the experience like of managing an inflation fund during an inflationary boom? And then also, how would you characterize the inflationary boom that we had? A lot of people say it was caused by the large amounts of fiscal stimulus, basically money printing. Other people say no, it was all about supply chain issues and oil and war and the like. Some people say that it was a mix of both. What do you think?
A lot to unpack there, but maybe let's back up. And so the fund was launched in January of 2021. CPI was still well below 1%. You had half of the people in the world saying that the economy was never going to recover from the pandemic. Some other people saying we were going to go through this boom. A lot to be decided, but we launched a predecessor to this strategy in 2017 where we thought that there was two overwhelming trends that were going to result in a macroeconomic regime shift. The first of which was under and malinvestment in a lot of the critical materials that run the world, or the old economy. So underinvestment in energy, in basic materials, in agriculture, but also in things like infrastructure, the power grid, water systems, et cetera. Those are very relevant today. We can talk about those later. That was colliding with what was, at the time, very elevated fiscal spending for a time period that was non-recessionary. So if you go back to the fiscal deficits that were run after the 9/11 attacks, you have this large deficit spend to stimulate out of a recession. But then after every subsequent crisis, so global financial crisis and then the pandemic, not only did you have progressively larger stimulus spending to combat those recessions, but then the normalization or the recovery spending was materially higher, such that leading up to 2020, we were still spending 3 to 4% of GDP in deficits. And so you have this sustained structural higher level of government spending and malinvestment. And we said eventually this is going to create a higher level of inflation. So we weren't forecasting 8, 9, 10%, but we were certainly thinking 2% was well too low. And that was going to create a structural regime shift relative to very low rates, very low inflation, which was ultra accommodative for profit margins, multiple expansion, et cetera. And I think that we've kind of come full circle now where that's the new reality. And half of the market isn't priced for that, half of the market is. But most people seem to just not really accept the fact that we're not going back to 0% interest rates. We're not going back to sub 2% inflation. And we're probably, I don't see any way that we're going back to any semblance of a reasonable deficit going forward. And so the playbook is extremely different today than it was pre 2020. But again, a lot of capital assets aren't priced for that.
And so you don't think inflation is going back to 2%? We're pretty close to 2%. About 2.5%, let's say. Inflation has fallen a lot. Why don't you think it will continue? And why do you think that 2% is kind of a floor?
Well, I think that one of the dirty secrets is that global central banks want inflation. So if you accept the premise that part of their mandate is to fund the treasury or fund basically the nation that they represent, right now you have the interest expense in the United States approaching $1 trillion a year. And that is part of why you have this structural deficit. One of the only logical scenarios, short of austerity or default, or growing out of it, which I think is a mathematical near impossibility, is to debase, kind of in the Russell Napier camp. So the way to do that is to try to get rates as low as possible while having high nominal growth. And part of that nominal growth is inflation. So part of the only reason why the debt burden isn't so extreme today relative to GDP is that we had that period of extremely high inflation. And so I think that governments are very happy to have 3, 4, maybe even 5% inflation. 8, 9, 10 is not tolerable. But forget the fact that that's probably their implicit incentive. It'll never be explicit. But again, you're looking at people have been calling for a recession as rates were starting to hike, and people were looking at all these leading indicators that were saying the economy was rolling over. But again, circle back to the fact that we're spending $2 trillion of deficit spending a year here in the United States. That's keeping a good amount of economic activity moving. And so because of all those variables that are pro growth and pro price levels, add in some of these kind of supply side issues, and then add in these exogenous things like reshore, onshoring, and things like building out data centers and building out the power grid. And basically all of that adds up to a structurally higher base rate of inflation, no matter how you want to measure it.
Right. I mean, such central banks, the Federal Reserve, quite open in the fact they don't want 0% inflation. They want their target is 2%. I don't know if they want 4 or 5% inflation. Perhaps they might prefer 3% inflation to 1% inflation. But so when you say you think inflation is going back high, that's you making a macro call. But when you structure your ETF ticker, which is INFL, it's not so much about the macro call. It's about buying high quality companies and doing well. And I'd like to congratulate you, Horizon Kinetics, Murray Stahl, the founder, of just having a fund that has performed well. As we record this, it has beaten the S&P 500 without owning any of the big, large cap tech stocks. If you're a stickler about Sharpe ratio, I believe that has had probably a little bit more volatility as well. But that is an accomplishment. So congratulations. Just want to give you your flowers for that. But I believe it's the case, James, just looking at it, that your fund has done much better this year, 2024, when inflation has fallen more sharply than 2022, when inflation was on the rise and very high. So what does that tell you, that your fund did a lot better when inflation was going down than when it was going up?
Sure. And one little nuance is that I don't think we're making a macro call. I think that we believe we're in a structurally different economy that is supportive of price levels versus non-supportive of price levels that was really the norm in, call it, 2010 to 2019. So whether you want to, depending on how you want to measure inflation, or whether it's 3%, 4%, 5%, whatever it may be, we think that it's just a very different macro regime. And part of that is very constructive for real assets. The problem with traditional real assets, which if you're in a traditional allocator, that means natural resource companies, real estate companies, infrastructure companies, is that they are both capital intensive, cyclical, and rate sensitive. So let's take the latter two, infrastructure and real estate. Phenomenal assets. I think they're probably going to garner a lot of attention in a world where people are going to need inflation indexed income. But a lot of these assets are sensitive to long-term rates in the form of the cap rate, which is implicit in their valuation, but also short-term rates in the sense on how they fund themselves. So I think that your best case scenario with a lot of those assets is that your return is going to grow at best with net operating income. It's almost impossible that you're going to experience that much of an improvement in your cap rate, because again, let's say we cut another 100 bips, 200 bips, I have no idea. But what if the yield curve is positively sloping, which it should be in a normalized environment? That's where your cap rate is anchored. When you look at resources, yes, you have the rate sensitivity, yes, you have the cyclicality, but you're having a lot of cost pressure on the operating side and the reinvestment side. So look at Newmont Mining, one of the largest gold miners in the world that had very disappointing results a week or two ago. And a lot of it was around their all-in sustaining cost creeping up much more than investors had expected. And that's a function of labor. Now they're going to have a little bit of tailwinds in the form of energy going forward, but as these cycles mature, it becomes more expensive to extract these resources. There are lower and lower quality ore grades, whether you're talking copper or gold or silver, generally lower quality resources in energy as well. And so you're also reinvesting your capex into a lower quality, more scarce universe. And that's why you're seeing M&A. So if you think about that, so with all the global energy companies, they're just buying each other. So while people can argue about what balances are going to be in 3 months or 6 months or 9 months, and OPEC can argue with the IEA and the EIA, the fact of the matter is non-OPEC global supply is not increasing because everybody's just consolidating, and that's going to have consequences. So when you think about that level of capex and how that's very difficult for going back to my original point, is that these companies, particularly on the operating side, are having rising expenses, and then they're also having rising capital expenditures. So those are directional bets. You're making a bet on the resource, on the cycle, on the valuation, et cetera. When you look at what we own, these capital light business models, we're trying to smooth out the cycle to where you can own these over 5, 10, 15, 20-year periods and compound your capital by virtue of them being capital light. And as you mentioned, we think that a big part of how we've outperformed all of the relevant benchmarks for the fund, including the S&P 500 over the past nearly 4 years, is that we capture the upside when the market is accommodative. So we've captured the upside in 21, we captured the upside in 24, but we also didn't participate in the downside in 22 when equity markets were down 20%, certain growth markets were down 40, 50, 60%. And so it's equally, if not more important, to preserve capital during those periods when rates were being hiked. They were really combating inflation. People were worried about a recession, such that you can then compound off that established base. And so now, about 4 years into the fund, having compounded in the vicinity of 15 or 16% a year, we think this is actually a much more sustainable environment. So inflation goes to 10%, everybody says, great, let's go buy this inflation fund. Well, first of all, it's not an inflation fund. It's a real asset fund that is oriented around compounding businesses that happen to do better in these environments. But I was telling people 10% is not good. Maybe it's great for short-term performance, but central banks are going to have to go very aggressive with their policies, as they did. You could argue whether interest rates actually had the effect that people think they did. I would argue no, but that's probably a much longer conversation. But now, slightly elevated inflation, and again, you could argue the nuance 2.5, 2 or 3, 3.5, with slightly more accommodative monetary policy and the continuation of fiscal support, that's where you can really compound. So you're not swimming upstream anymore. And that's why we think that we're in a really good position today. But again, these past 4 years has almost been a full cycle of rates, inflation, and growth condensed into a 3.5 year period. And now we're at this whatever landing you want to call it, and we're going to see kind of what the future looks like.
I guess the importance of a capital light business is really important. I guess you talk about like 3 levels of businesses, none of which I don't think are in your INFL fund, but just like a credit card company like Capital One. So they have to spend a lot of money on operations, writing down people who don't pay their credit cards back, marketing. They've got to get Samuel Jackson on the ads. Then a higher level business would be something like American Express. Probably less capital you have to put out because but then I think probably the highest quality business of all, where the least capital would be something like Visa, where you're just getting paid and you don't have to put out new capital. Why is that so important? And can you talk about how that principle animates a lot of the holdings of INFL, your fund?
Yeah, I mean, I love that example. And so when you're a credit card lender, you're sensitive to your funding rates versus what you can earn on that capital. So all of any balance sheet based company is taking balance sheet risk, proprietary risk, and earning a spread on that risk. And that's why these businesses tend to trade around book value, because it's pretty hard to consistently earn a high net interest margin or spread on that capital. And when you do, it's a low return on assets because you can't take that much risk. And you can then lever that up to earn a reasonable return on equity. Banks today are levered up about 10 times. Go back to Lehman, these things were levered up 45 times. And so you could see how it was pretty easy for a small impairment to your equity to topple all of these banks. But you can think about how that's a cyclical business and a moderately risky business. I could argue that they've been de-risked a lot today, but looking at a MasterCard or Visa, zero proprietary capital risk. They're not lending any money. They're not funding and matching liabilities to their assets and their duration. They are an intermediary where their revenue is a function of volume. And then it's basically a platform where their costs are largely fixed. So the more volume that goes through that network, the more revenue that they make. Largely, it's going to be a fixed margin that's all going to drop down to free cash flow. So think about those two businesses and think about which one you would rather own. It's obvious you want to own MasterCard. And so that distinction is obvious in these larger industries where you can see the multiple that's being paid for MasterCard and Visa relative to the Capital Ones and the banks and the insurance companies of the world. But I would argue a company that we own or companies that we own in exchanges, very similar business model, a little bit less smooth of an earnings trajectory than the credit card companies, but it's the same thing. You don't have that balance sheet risk. Volume times price is revenue, very high margin, very high recurring revenue. Those are the businesses that can compound over time. And I think that's why so many people have gravitated towards the capital light payment processors that you referenced.
And so something like Visa, I don't think it officially is a royalty company in the ways of commodity royalty companies, many of which your fund owns, but it does have that similar properties. So let's talk about gold and gold miners. For example, in 2022, if you said in 2021, you said I think inflation is going to soar. So obviously gold does well during inflation, and gold miners are levered to gold. I'm going to buy gold miners. Your macro call would have been right. Inflation went from 3% to 9%. However, the price of gold actually went down for reasons that no one really knows, other than there's more selling than buying. And actually, gold miners, because of inflation, their costs went up dramatically, and their revenues in terms of their realized price of gold went down. So their all-in sustaining costs, how much they had to spend to get the gold, went up. Their realized price of gold went down. So they actually had a very, very bad year in 2022. Compare that to some gold royalty companies, many of which you own, even though the price of gold went down. Talk about the capital that went in and why they, on a fundamental basis, did a lot better than, not talking about stock price, but on a fundamental basis, did a lot better than the gold mining companies.
Exactly. And I think that that's a great example where, again, if you're going to own any upstream commodity producer, you're taking fairly high directional exposure on that commodity. And in the case of gold companies, yes, you have a directional exposure to gold. And that's what everybody understands. But you also have to understand what are the inputs that are going into their cost structure. So on the operating side, labor is the biggest problem for mining worldwide today. And it's a large and growing problem that's not getting any better anytime soon. And look no further than the amount of kind of engineers that are coming out of mining schools today. But also you can look further down at the manual laborers that are kind of doing some of the more high labor work. But then you also have your energy costs. So a lot of these mines burn a lot of diesel. That was extremely prohibitive during the peaks of energy prices. It's obviously helping them a little bit better today. But so you had a double whammy where you make a macro call on gold and you think, let me buy the miners. Miners look cheap. They're below 10 times earnings. I think I want the positive leverage to gold. But not only did gold not work, but the cost went against you. Come full cycle, also the reinvestment capex is going up too, because if you want to start developing new assets, well, it's going to cost you more for labor, more for equipment, more for materials, et cetera. So it was kind of a perfect storm for miners not to work. The royalty companies benefited for a lot of variables, but number one, they're generally not exposed to those dynamics of OPEX and CAPEX. So if you own a royalty or a streaming agreement, which is a slightly different variation of a royalty, your revenue is driven by the production of that mine. So yes, the price of gold coming down is going to hurt you dollar for dollar. As long as the production is there, though, which as you've had plenty of guests that have mentioned this, but it's so wildly prohibitively expensive to shut down a mine that you're going to run mines in some cases for years at negative incremental profit margins, because if you're going to shut it down, you're basically saying we're bankrupt. So as a royalty holder, because you have generally what's a gross revenue interest, you're continuing to generate profits. And plenty of our energy royalties were cash flow positive during the first and second quarter of 2020, when you're seeing billions of dollars of write downs at the producers. So you're sustaining your cash flow and value. And that's important for two reasons. One, you don't have to sell assets, issue equity, issue debt, do things that actually create permanent damage to your business, but you can also invest counter-cyclically. And this is something the royalties do, and they do very well. So when there's blood in the streets, they're investing, and they're investing aggressively because they don't have debt financing. They have plenty of equity capacity. They have plenty of cash flow. Miners, every single cycle, they invest pro-cyclically. So as prices go up, they invest. It rolls over, and obviously they go over the hill with it. So because of that dynamic of sustaining during the trough, then leveraging the eventual upside, is why these investments have done so well through this cycle. But also, if you zoom out and look at 10, 15, 20, 30-year cycles, they've really been the preeminent asset class across these commodities.
Right. And one company that you own, Franco-Nevada, I want to say you, of course, I mean your fund, INFL, is a gold royalty company. But gold royalty companies, they do have to, not constantly, but frequently reinvest and into new projects. And often they will get a positive return over time. In some cases, a very high return over time. But compare that to another stock that you own, TPL, and a lot of Horizon Kinetics owns TPL, Texas Pacific Land Trust. That I don't know if they really do any or really acquisitions at all. They just have owned this land for over 100 years, and it just keeps on generating returns. So they're not having to write a check, every month to fund some new project in Guatemala. They just own tons of land.
Exactly. And I mean, so TPL is just such a unique situation where they were basically bestowed with one of the best land and mineral packages on earth by virtue of the Texas and Pacific Railway, which went bankrupt in 1888. So you can't come out, no matter how much money you had, you couldn't come out today and recreate that portfolio. And so that's such a different business model because there's not a lot that they need to do. Now, as the company has matured, they've done some small bolt-on things with both surface acreage and minerals. But yes, to your point with Franco-Nevada, they've been doing this about 40 years, since the early 1980s. And the great story with their original mine was they wrote a royalty on the Gold Strike mine in Nevada. And they spent $2 or $3 million to get a royalty on that mine when it was a small, I think it was about a 500,000 ounce resource. And lo and behold, American Barrick came in and turned it into a 5 million ounce resource. But through today, that $2 or $3 million check has given Franco-Nevada shareholders about $1.2 billion in cash flow. And by our estimates, there's a couple $100 million left. those things don't happen every day. They probably can't happen in today's market where there's less information asymmetry. But because of the nature of Franco, where some mines are coming offline and maturing, others are starting to be developed, they are constantly recycling some of their capital into developing those resources. But one of the nuances, particularly on the precious metal side, is the largest precious metal royalties in the world today are not gold mines. It's byproduct from copper mines.
Hmm.
So the beauty of that is that a great gold mine today might have an 8 to 10 year mine life. They're just, the monster mines just don't exist anymore. A great copper mine could be a century. So having a royalty that is 30, 50, 70 years with upside. So the other great thing about a copper mine and mining that's different from a lot of other assets is the best place in the world to find new copper is where you already know. So you go deeper or you go laterally. And in many cases, these royalties encompass the entire mine plan. So because you have that longer duration, there's a lot more value for you as a royalty holder because you don't have the sensitivity of expenses. You go deeper, you go laterally, you have higher extraction costs. That's on the operator. But so that's another reason why the precious metal royalties are so interesting is that there's that right hand tail that if you really believe in our thesis that we're in a structurally higher price environment, most royalty investors and resource investors, they're ultra focused on years 1 through 3, maybe 1 through 5. And they basically ignore 5 through X. Well, we're saying there's a lot of value in 5 through X. And if you can intelligently underwrite that, that's where a lot of value is in the right business model. And that's what really leads you to royalties.
Right. I guess it is slightly dependent on the management. Are they making those good acquisitions? Are they doing it at a time when prices are depressed rather than when prices are high? Of course, when prices are high, that's when everyone's bullish and excited and wants to do acquisitions. Let's talk about TPL. From Wikipedia and then my own math, I calculated that if there was one guy who, I think got $3,000 in 1888 of the bankrupt railroad that became Texas Pacific Land Trust, if he never sold the shares, that would be what was converted. It would be worth over $1 billion today. So it is one of the greatest compounders in the history of capitalism. And Horizon Kinetics and founder Murray Stahl and yourself have been involved in that. So congratulations. How are you thinking about Texas Pacific Land Trust now, where I'm just on Google, it has a trailing price to earnings ratio of 69, which is obviously expensive. And I think a lot of companies, not in the royalty sector, but in all the entire stock market, the market, they have a very low capital need, so they can have a very high return on capital. But the market is aware of that. 10 years ago, they were undervaluing that, but now they value that. So you have very high quality companies that have a price to earnings ratio of 50 or 80 or 100. How are you thinking about that? And why not just take a little off the table and sell when these companies have such high valuations?
Yeah, and I think you could have made an argument probably pretty consistently for the past 30 years to sell Franco-Nevada, to sell Wheaton Precious Metals, similarly to sell Texas Pacific, and obviously you would have left a lot of upside on the table. But I think, first of all, the PE isn't all that relevant. And the best analog I can give is think about an apartment building. And if you're only leasing out 5 out of 50 floors, clearly that cash flow is not indicative of the value of that building. But let's also say not only are you only leasing out 5 out of those 50 floors, but what if that apartment building is in an up and coming area where there's a new Google office complex coming in and a new university? So clearly there's a lot of value that's going to be ascribed beyond even what the current cash flow of those 5 floors is. Obviously, that's not a one-for-one example, but one of the things that's so unique with TPL is that you have the minerals and you can argue until you're blue in the face. What is the proper assumption for oil? What is the proper assumption for gas? There's a little bit more structure around what is production going to look like, but really you only have a line of sight for a couple of years. And then, some people tell you that we had peak oil in 2019. Whoops. Some people are now acknowledging that we're going to need oil for a lot longer. The area where we saw, excuse me, I should say Murray saw the value that I think everybody missed was that people basically said, okay, you've got this 1,000,000 acres of scrubland in West Texas, and you fly over it, and it literally looks like you're on Mars. If you've ever been out there, it's just a dirt patch. I couldn't even call it a desert because it's you think of deserts, you think of kind of like the rolling sands, but it's like scrubland with brush and dotted with derricks and small little oil clearings. But people would say, look, it's ranch land, and historically it was grazing land for cattle. It was worth almost nothing. But incrementally, there were higher and better uses. So all of a sudden, somebody needs to put in a pipeline. Okay, there's an easement. Somebody needs power lines, another easement. You need an access road. Now you need a gas gathering facility. Oh, now you need an area for a tailings pond. The next iteration was water. So oil and gas wells both require a very significant amount of source water to frack. They also generate massive amounts of water in the formation when you break that shale. So in the western side of the basin in the Delaware, it averages about 5 or 6 barrels of water cut. That needs to be removed, remediated, transported, and disposed of. So now you've got this business. So those are higher and better uses. But now looking forward, there's some really interesting dynamics around wind and solar. So Texas is very flat and very hot. It also has an unregulated power grid where you can basically plug those in. You can be behind the meter or you can be fully off the grid and support different facilities. You've seen Bitcoin mining. But I think one of the really exciting opportunities now is data centers. And you think about what are the biggest constraints for data center development? Well, it's land, it's power, and it's water. And Texas has a heck of a lot of land. It has plenty of natural gas where you can do direct generation. If you're a hyperscaler, you can plug in some wind and solar and say that you've got some green stuff. There's also plenty of potential for carbon capture. You have an unregulated power grid with ERCOT. So again, you can either be behind the meter or you can plug in and do demand response, kind of like the Bitcoin miners. And by the way, you have this massive water business as well, where not only does power generation require a lot of water, but so does liquid cooling and liquid immersion, which is basically the only way to economically cool these data centers. And to quote the CEO of DigitalBridge, which is a phenomenal leading alternative asset manager in digital infrastructure, he said, look, everybody's focused on the power backup today, which is significant. He thinks it's more related to transmission than generation. It's like the crisis that is ahead that no one's talking about yet is water. And when you look at all of these areas, well, it's almost too perfect for data centers to ultimately end up in West Texas. You could argue about latency, but I think that that's something that not every application needs to have instant low latency. But again, thinking about the optionality of land that so many people wrote off as a zero, now maybe or probably that could be worth multiples of what the minerals are worth. There's two different assets within TPL, which makes it very distinct from most royalties, is that most royalties is just mineral. So the mineral is a subsurface right of the revenue related to the extraction of oil and gas. That is separate and severed in 99% of cases from the surface estate. The surface estate is a fee simple surface ownership. Like if you own a house, you own your house lot, probably fee simple. Due to the nature of the trust and then the separation of the original assets, which are now part of Chevron, of the operating assets, TPL retained both the surface and the minerals. So they have 1 million, give or take, surface acres. And that surface acreage is what people have said for decades was worthless. Now it's pretty apparent that it's worth a tremendous amount of money. And there's another company that's come public recently called Landbridge, which is kind of, the market has basically certified, yes, West Texas surface acreage is worth a considerable amount of money.
Yeah, so looking at TPL, 4 main revenue streams: oil and gas revenue, still over half. Then there's surface leases, easements, and material, basically, I guess, building pipelines, whatever you want to do on the land. There's water sales, selling water to go into the ground, and there's produced water royalties, I guess, to deal with the water that comes out. So tell me, this transformation with AI, are people already building data centers in the deserts or the dust pass of West Texas? Is this just people are talking about it, or are these projects that are in the process of being built or having built already? How quickly is it happening?
There are Bitcoin mining facilities, which are low tech, low sophistication, but some of these facilities are hundreds of megawatts, and they exist in the Permian, they exist in Texas, and the big trend in Bitcoin mining companies is converting these to high performance compute. So HPC is basically saying we're going to convert to data centers, and the data centers are for GPUs and LLM training. Why are they doing this? Well, their asset is not so much the facility. You're talking millions of dollars per megawatt to upgrade a Bitcoin mining facility to an HPC facility.
Which is
But
high
they
power
have,
compute, right? HPC.
yeah, high performance compute.
Yeah, thank you.
The distinction is what do they have? They have the land, they have the power, and in some cases they have the water. And so that's where the value sits. The value isn't in this box. It's basically an air conditioned, low sophisticated box to just run these chips. So that is up and running and happening. You've seen Mike Novogratz at Galaxy Digital. They, in one of the greatest transactions ever, bought Helios out of bankruptcy, I think for like $30 million. And you could argue that HPC conversion is worth billions alone. But yes, so yes, you're seeing it happen. What we think the future is going to look like, and this is corroborated by experts in the industry, is you're not going to see hyperscalers just plant their flag and say, give me a gigawatt data center. You're going to see data center campuses where you're going to see multiple gigawatts on a campus where there's microgrids, redundant infrastructure for water, wind and solar being plugged in, advantage gas distribution, which goes into direct generation. And there are several companies with letters of intent that are out, and there are a variety of these that are pending. We're optimistic that you'll see something executed by the end of this year. So there are very late stage projects, but nothing that I would say is actually broken ground in terms of a full partnership with a hyperscaler as of yet.
And how does Texas Pacific Land Trust or Landbridge actually make money from having these data centers on it? I understand that they do make money, they will make money, but what is the technical process? What are they being paid for?
Sure. So the most basic layer is you own the dirt and you say, here's a ground lease, and you need to pay me X million dollars a year on a 99-year lease for the ground lease. So again, just like any other commercial real estate transaction. And generally, from our understanding, you need about 1,000 acres to even start this conversation, which is, so in West Texas, these are sections, or in most of energy world, these are called sections, which are 640 square acres, which is a square mile. So about a section and a half. So that's layer one. Layer two, though, is, well, if you're sitting in the middle of my land, I might as well give you gas. And so can you provide gas for that turbine, which is ultimately the only way that you can provide anywhere near the amount of energy? So earning money on pipelines and easements for that. In some cases, you could even have royalties and offtake with that gas. You could then develop wind and solar farms where you could earn a royalty on megawatt hours generated, which supplement the non-intermittent power. Then you have water. So you need to have water constantly cycling in and out of that power generation, as well as into the data center itself for cooling. Then you have access roads, you have power lines. You're probably going to need to see some variation of working camps, because I think that if this actually comes to fruition, you're going to actually have to have almost like oil rigs where people fly in and work 3-day, 5-day, 7-day, 10-day shifts. And so you could see that based on the original ground lease, the amount of iterations of additional revenue streams become really big, really fast. And I think that's why the market's getting so excited about the opportunity.
Yes, you say the market is getting really excited about the opportunity. Just to give people a sense, this stock Landbridge is up a tremendous amount. It IPO'd in late June. I actually got lucky that I just happened to run across the Horizon Kinetics, I believe, the second quarter commentary, and I read about Landbridge. And back then, the stock was at probably gone from 23 to 35. I said, oh, this thing, Murray's probably right about this, but it's gone up a bunch. I missed the train at 35, and then it went to 40 and 50, and it went as high as $80. It's now pulled that back to 68. So this stock has run up a tremendous amount. So the last thing I want to do is kind of pump the stock on a short-term basis, because it's literally doubled over the past 2 months, and tripled since inception, again a few months ago. But tell us about Landbridge. Let's get into it, and then how does it differ from Texas Pacific Land Trust? It does have oil and gas or royalties, as well as, I believe, a few days ago they just came out with their most recent quarter. What did you notice? What stood out to you?
Sure. So just quick background on what Landbridge is. So Landbridge was created by 5 Point Holdings, which is a energy-focused PE sponsor run by David Capobianco. David worked for Paul Allen of Microsoft Vulcan family office, and he actually saw such a great opportunity in handling water in West Texas that he left to create 5 Point. And his biggest asset is called WaterBridge, which all indications suggest should be coming public probably in the middle of next year. But that's a huge water infrastructure company for handling that produced water. They noticed very presciently that one of the biggest constraints to that business is owning the land. So they're constantly dealing with ranchers and corporations and the university system saying, look, I got to buy an easement to cross your land to build this gathering system to move water. So they said, we should really buy some land. And I believe it was about 2 or 3 years ago, they bought the original about 75,000 acre ranch. And it's actually interspersed with Texas Pacific's land right around state line, the border of New Mexico and Texas, which is the Times Square of oil and gas energy corridor, the best wells, the most activity, everything. And so that was their original cornerstone asset. And they basically then used WaterBridge, funded by the GP, so no Landbridge capital, to develop this massive water infrastructure business. And they ran Landbridge as a royalty on land. So you're talking 90% operating margins, 72% fully tax-free cash flow margins. And the team recognized, look, this is a really interesting asset. We talked to them a couple of years ago, loved it, loved the management team, needed to get a little bit bigger. And they were ultimately able to add another 150,000 acres earlier this year through 2 ranch acquisitions, DK Boyd and the Speed Ranch. So now you're talking scale, 220,000 acres versus, call it 75,000 acres. And the beauty of the asset was we had the blueprint. We saw what you did on your original acreage. Do the same thing on this underdeveloped additional acreage. And so we were looking at trailing cash flow multiples. The IPO priced at 17, which was about 12 times. And we were just like, wow, this is really attractive considering we think it's not that big of a stretch to think this thing could grow 15 to 20% for 5 years. So that's the simple case. But then they were also very prescient in realizing the huge opportunity is data centers. And between their expertise in water and then the ability with gas and infrastructure, they were one of the earliest people in identifying sites. So they've already identified 6 premier locations where you could basically plug and play very large scale data centers with the supporting wind and solar, with the direct generation, with the water, et cetera. And so you can see it was a really easy story for people like us that understood the land value from TPL, understood the royalty value. But during the IPO roadshow, I mean, quite frankly, they didn't know who to talk to. Like, who would understand this thing? And I think because of that lack of appreciation of the opportunity and the business model is why it priced where it did. Today, we look at the stock that's gone from 17. I know it was in the 70s, maybe it's in the mid 60s today. But in their earnings release, they laid out, yes, we're executing the plan just like we said we would on our new footprint. That's the blocking and tackling. But we continue to see very large and considerable interest in developing these hyperscale data centers. And Texas, they reiterated, Texas and the Permian is a very logical choice for where you're going to see mass compute going. And what better way to play that than through the royalty on the land, the water, the gas, the power, than trying to day trade IPPs and liquid immersion technologies and industrial components that are trading at 90 times trailing earnings.
Sorry, what's IPP?
Sorry. So one of the biggest trades for data centers is what are called independent power producers. So without going too deep in the weeds, most US utilities are either rate based, which are government regulated in providing base power. There's a subset of what are called independent power producers where essentially they only fire up their plant 5-10% of the days, but they do it when the base load has gone into a maintenance zone where they need to basically pull power to maintain that reserve requirement. So, Dallas hits 120 degrees. All right, fire up that NRG or, Calpine plant to basically supplement the power grid. So they might be charging $3,000 per megawatt hour. Or when Dallas froze a couple of years ago, they were charging I think 9,000 is the regulatory maximum. But the idea here is you only run 5% of the time, but you charge such outrageous prices, they make a ton of money. And so the logic is these merchant power or independent power plants, now they can sign these power purchase agreements with data centers to where they're going to be running a lot more than 5%. Are they going to be running 15%, 20%, 30%, 50%? Although it's not as simple as meets the eye, where there was a deal with Talon Energy and one of their nuclear facilities in Susquehanna where Amazon wanted to co-locate but not pay the grid fees. And so it's a tricky situation. They're more complex than people think. The pod shops love these things, but that seems to be where a lot of the hedge fund and the hot money's been going to play the data center thematic.
And sorry, what are a few examples of names of independent power producers? I'm not that familiar with it.
Sure. The big one is the biggest ones are Talon Energy, NRG Energy, Vistra Energy. There's some other one. Constellation Energy is another one. Calpine. There's another really idiosyncratic one that's called Hallador Energy, which basically is an IPP with its own sourced coal. But those are all in that ecosystem of having the ability to really inflect their cash flows with direct power purchase agreements.
Yeah, Hallador, I think that's a company that almost went bankrupt in 2020. So a lot of these companies, when they have capital needs, they have.
Well, that's when it was just a coal miner. They signed an intertransmission agreement with Indiana Power for this power plant that everybody thought was worthless because it was basically a peaker. So sorry, there's all these different you can call it merchant power, independent power, or peakers, where they only generate power when you need peak. Basically, they basically almost gave this thing away to them in 2022, and then people realized, wait a second, these things might be worth a lot of money. So very different asset today than when it was basically a captive coal asset to feed this Indiana power plant.
James, a movie I like, a lot of people like, I'm sure you like as well. There Will Be Blood. Two concepts from that film that I think are relevant here. Number one is getting an easement. That is when you have to get someone either to sell you the land or get them to agree to give you the right to build a pipeline across it. And the second one is, of course, the famous "I drink your milkshake," which is if I own land over here, you're my neighbor, and I drill in my thing, I got your oil. Murray Stahl has written about how Texas Pacific Land Trust has benefited from the rather diversified holdings that they're not contiguous. Texas Pacific Land Trust, they own some over here, some over here, some over here, so they actually get to drink a lot of the milkshake just because of where they're so not non-contiguous. However, Landbridge is contiguous. Can you talk about that geographic difference and how that makes it into a different sort of pitch, different reason for why it could grow its earnings?
Sure, and there's merits to both. But as you're alluding to, TPL's land is primarily in a chessboard alternating pattern, and that goes back to the land grants in the 1880s. And the benefit of that is, for their water, for their infrastructure, for a lot of their businesses, they can almost block off entire sections of the Permian Basin by virtue of that checkerboard pattern. And so with water aquifers, they have that milkshake theory because it's that's kind of how water is still regulated in terms of source water. But with energy, now it's very technological, and we know if you drill vertically and then horizontally into somebody else's section, you have what's called a pooling agreement or a shared drill spacing unit. So that analog is a little bit dated, but it still pertains for water at the margin. But the value of the land being so vast and alternating has created a lot of value for TPL. So Landbridge, it's actually better in some instances. So I mentioned earlier that we think you need about 1,000 acres for a data center campus, and that's 1.5 sections. So if you have one 640-acre section, you need to annex another section to basically have the ability to develop that base campus. But then all of that peripheral acreage is also relevant for getting the gas, getting the power, getting the water, getting the wind and solar, et cetera. And so there's merits to both. But the real value here is if you have large plots of land in the right zip code in West Texas, the surface is worth a lot of money. And that's something that I don't think is any longer up for debate.
James, let's talk about the companies that are not royalty companies. You also own companies like Intercontinental Exchange, Kaki International, Singapore exchanges. Why do exchanges or these types of financial intermediaries, why do they benefit from inflation?
So again, go back to your MasterCard and Visa example. They have zero proprietary risk. It's a toll booth on flow through their system with almost zero variable cost for each transaction. So incredibly high margin, incredibly capital light business. Exchanges are essentially the exact same business model, except they have half the multiple of the credit card companies because their revenues can be a little bit less smooth. And so the growth rate isn't all that different. But what drives volume on exchanges? So volume equals revenue. What drives volume? Well, it's nominal GDP growth, it's velocity of money, and it's volatility. So in a world where we see higher nominal growth, higher price levels, et cetera, clearly that's going to be very conductive to revenue for the exchanges. Analysts see the volatility. So in the first quarter of 2020, in 2008, 2009, spreads blow out, volatility blows out, trading skyrockets. It's actually, as the rest of the world is, hemorrhaging, it's their Super Bowl. They're having their best quarter ever. But so that illusion of variability in earnings results in these companies having a much lower multiple than almost identical businesses elsewhere. But again, if you were to drill down further, what are the products that are driving these exchanges? Well, it's derivatives. There's really no money in multi-listed options or cash equities anymore. It's in these proprietary derivatives where then you have a captive clearing through the clearinghouse. We can get into that in a minute if you want. But what are those biggest markets? Well, it's interest rates, it's currencies, it's commodities, and it's index futures. So think about the old pre-2020 world. Well, no need to hedge your FX, no need to worry about interest rates. Commodities are going nowhere. Maybe you could speculate on a 10 vol index future, but take a nap in between. Fast forward to today. Yep, probably want to look at your FX, definitely want to look at your interest rate exposure, probably want to hedge your commodities, and definitely a lot more action in the index. So it's almost a perfect environment for these exchange businesses. And capital light, 40% operating margins, convert almost all that into cash flow, and then have this circle of recurring revenue businesses related to data and analytics and subscriptions, to where they're just incredible businesses that honestly do well in almost any macro regime, but particularly the regime that we think that we're entering today.
All right. So you talked about the type of companies that benefit when spreads blow out. When you mentioned that, I thought of typical market making type businesses, Citadel, Susquehanna. I think one of the only companies, the trading businesses that is publicly traded, is Virtue Financial, which has, to be fair, underperformed the S&P drastically since inception.
Yep.
Just so you know, but talked about how exchanges benefit from spreads blowing out. I really don't know how that exchange business works at all, to be honest. And then talk about the clearing too.
Yeah. So the market maker, the Citadels of the world, and the Virtus and the Jane Streets, they're some of the largest customers of the exchanges where they're making markets. So what they want to ideally do is they want to take flow from sell book and buy book and then basically match those and make something in the middle. The exchange is where this transactional volume takes place. So the market maker, they have funding. So they're basically paying somebody for their funding. And then they're taking risk. They're taking proprietary risk in the case of matching buyer and seller. So the more that they're able to generate profits from doing that, the more revenue, that the more volume at the exchange. So again, let's juxtapose these businesses. The exchange, when spreads blow out, it's the Super Bowl for these market makers, because now they're just clipping quarters and pennies and dimes just left and right on all this volatility, because nobody really knows where the market clearing price is. So it's phenomenal for them. When there's no vol and markets are very tranquil, the spreads get much, much tighter, and there tends to be less volume, although the algos and the Citadels of the world can sit there and clip away. But again, there's risk. You're taking proprietary risk, you're taking balance sheet risk, things can move quickly and hurt you. At the exchange, to the extent there's all these tailwinds driving the volume, they're simply the toll booth saying we have no proprietary capital at risk, but as you trade, I'm just going to take my tariff as you keep going through my toll booth all day. And so that's why we love the exchange rather than kind of the more capital intensive, where there is proprietary risk on a lot of their constituents that are trading.
Right. And so Intercontinental Exchange, which your fund does own, they own the New York Stock Exchange, which is obviously well known. On my previous show, for guys, I actually interviewed a former senior executive from that business. So I learned that actually the New York Stock Exchange is a small fraction of the business. A lot of it is in clearing and in credit. They also bought some mortgage, I think Black Knight or whatever, so mortgage type thing. Tell us, when we did an interview, James, in 2021, almost exactly 3 years ago, you also owned CME, Chicago Mercantile Exchange. I don't believe you own that now. Perhaps you had to, boot out CME to make room for Landbridge. Why did you choose to boot out CME versus ICE and maybe another type of company, SIBO? I don't know if you ever owned that, but the Chicago, options. I just checked. You don't own that now in INFL. Why? And how do you talk about how you have to make these decisions where this company is, an 8 out of 10 and this one's an 8.1 out of 10? And how do you make that decision?
So it all comes down to valuation and the risk associated with where are they competitively positioned, what are the KPIs, what are the business drivers, and then what's the valuation. And we really like where ICE is and was positioned. They bought Ellie Mae. People were very critical of that, a mortgage technology company. Then they bought Black Knight. But their core businesses in derivatives, whether it's rates or energy, they have a great clearing business as well. And they were trading well below the market multiple. So love that business. Nothing against CME or SIBO, but so CME has always been the gold standard of global exchanges. And that's because they have a phenomenal interest rates, particularly SOFR and short-term interest rate and treasury business. They also have a dominant position in U.S. energy, so around the WTI complex. But two developments have happened this year that have made us just take a pause and wait and see. One is Howard Lutnick of Cantor or BCG Partners or BGC Partners. He is launching one of the latest iterations to challenge CME's dominant position in U.S. rates and treasuries. Phoenix or P8, what I think they're calling it. A lot of market participants think and thought that that was going to create a meaningful dent in CME's business. And quite frankly, people that we were talking to were hoping that it would, because I think a lot of people were becoming disenchanted with the dominance there. To be completely fair, if you look at how it's performed to date, the volume is not there. The bid-ask spreads are very wide. So thus far, chalk one up for Team Donahue or Duffy at the CME. The other, which again was a little bit confusing to us, is they just were granted a license to operate an FCM.
James, what's an FCM?
A futures commission merchant. And so basically what that means is they can almost compete with their clients in directing trades. And so you've seen some backlash there as well. And so because of these two events, you've seen this historic kind of golden boy of a business now come down and trade at a discount to the global peers. And so, it's one of those things where we don't have enough confidence in what's going to happen. So we're just going to wait and see, and, wouldn't be outside of the world of likelihood that we would re-engage in the position. SIBO, again, very interesting business, but their core business is multi-listed options, but their real cash cow is the VIX suite. So they have a proprietary stranglehold on the VIX. I think the VIX is a very crude, imperfect way to trade volatility or implied volatility. You've seen a lot of competing products come out there, but it's really a fairly concentrated business. And so trades at a discount to peers, but I think because it's much more singularly focused on a single product. And so when you look at these nuances between each exchange, then that I think puts the multiples in perspective and gives you a lot more clarity around what types of multiples you're paying for what types of business drivers.
Right. So Howard Lutnick, who is involved both with that other firm, but also Cantor Fitzgerald.
So BGC is the parent of Cantor.
Okay. Thank you. So he is now rumored to potentially be Trump's Treasury Secretary. The other main horse is Scott Bessent, who I thought it would be. We will see. So let's see. So, but just an example of how hard it is to displace this. I know there's a Texas stock exchange that people said would displace the New York Stock Exchange. I don't know if that's going that well. And likewise, there is a guy who literally invented interest rate futures, and he tried to create a thing. It was called Maribor to displace SOFR. And I don't think SOFR has been displaced. And I actually interviewed him. He's a fantastic legend in the business. But it's really hard to displace these platforms once they get started. James, so yeah, tell us, Chicago Mercantile Exchange, CME, I know they just grew tremendously from 2007 or 8 during that commodity boom because they traded commodities. Has the growth in their business been similar with interest rates over the past 4 years? Because I'd say we've kind of had an interest rates boom in the same way there was a commodities boom from 2000 to 2008. I mean, going from 0 to 5.5 and now to 4.75. That's people like to speculate on that, and I'm sure they have. How have you compared that? Or has the growth been good, but just not as good?
Yeah, so I'll touch on that in 1 second, but you brought up a really good point I don't want to gloss over. But typically, once you have the liquidity in a product, you are so deeply entrenched, no one's budging you. And so a great example is, why does the Intercontinental Exchange even exist? They were an electronic exchange in the 90s in Atlanta. And so everybody thought, this company's never going to even touch the dominance that the Chicago Board of Trade, the CME, and NYMEX had. Well, they launched a digital Brent contract for global crude where they were concerned with WTI and US benchmarks. They got the liquidity, they got the participants, they got the clearing. Today, it's actually bigger market cap than CME. So it shows you, once you get the liquidity, it's almost impossible to move you. And Terry Duffy at CME has said, look, many have come, many have tried, and many have failed. So a lot of people seem to think that this Lutnick endeavor was going to do something. And right now, I mean, it looks like Duffy's right, although the stock CME hasn't traded to reflect that. But going back to your direct question on have they benefited from rates? And the answer is absolutely. Every single exchange with interest rates in their product suite has benefited immensely by virtue of the normalization of interest rates. And it's really, there's a lot of different ways that rates have helped these businesses. So one, you do need to hedge. Two, now you have people speculating, and it's also created new products. And so now you've had different tenors, one rate versus another, SOFR or LIBOR to SOFR transition, but also the clearinghouses earn interest on the collateral. And in some cases, that's rebated to customers. In some cases, the clearinghouse keeps that and it's remitted back to the exchange. And so, yes, rates are immensely important to these exchanges. And it was actually very detrimental to them in that zero interest rate era, although they performed quite well in spite of it.
James, now I want to ask you a question, which is, so you are advisor on several Horizon Kinetics mutual funds. I think several mutual funds, but definitely the flagship mutual fund for Horizon Kinetics is quite lopsided. Since its inception, since the turn of the century, it has outperformed the benchmarks. But I believe a key reason that it's done so is because it has owned Texas Pacific Land Trust and not sold. And as a result, around 60%, I don't have the exact number, of that mutual fund is Texas Pacific Land Trust. And so is it fair to say that the reason it's outperformed is because Murray and the other investment professionals at Horizon Kinetics, such as yourself, have not sold, and how a key way to outperform the market is just to never sell good assets or rarely sell good assets. And if something goes up 60%, a lot of people sell it, but you don't actually want to sell it. And that selling Walmart from 1993 to 1994 after it rallied is a bad decision. Talk about that, and then also is it kind of ironic if this is the case that it's actually harder to get inflows into a mutual fund that is lopsided, but lopsided stuff tends to outperform. And the reason it's lopsided is a result of its outperformance. So I don't know if what I said is accurate. Correct me if there are any inaccuracies, but yeah, just your thoughts on that.
Sure. Short answer is yes. So the concentration of Paradigm has been directly attributable to its very substantial outperformance of any relevant benchmark and all of its peers. And short answer also yes, that if you find a once in a lifetime asset, as Murray did, he believed that it was detrimental to shareholders to sell that, both from a tax perspective, but also diluting the returns of a exceptional asset. And so what most managers would do is sell that. And they're not, even if they 100% agreed with Murray's line of thought, they would have sold because they are asset gatherers and not asset managers. And what I mean by that is what you alluded to, is you can't raise very much capital in a ultra concentrated vehicle the way you can if you have a nice diversified fund that has negligible tracking error to the index weights. So I think that there's really an increasing change in the investment management landscape where passive has become so dominant. And there's all these funds, and a lot of legacy mutual funds are effectively closet benchmark. And the reason that nobody's really selling those is that the tax consequences. But pretty tough to run an asset management business today if all you're going to do is reweight S&P 500 constituents. And so I think that the emergent class of managers is going to embrace idiosyncratic opportunities. In this case, Murray's embraced concentration, and other products like INFL, we have a lot more diversification, but it really is a prioritization of the compounding of capital instead of just trying to optimize to raise capital outside of capital.
And so in your ETF INFL, you said you want to be more diversified. Tell us about that. Is that to meet the needs and demands of the investment community who don't want to own a thing necessarily that has 60% in one asset? And if so, are you sacrificing performance? Maybe the next 20 years, in the same way you want to be concentrated in TPL and not be reducing as it goes up, you want to be not reducing in Landbridge as it goes up. This is not my prediction. I'm just saying a potential case. But what if the investment community is too, for lack of a better word, shallow, and they say, James, what are you doing? Landbridge is getting to be 30%. How are you going to navigate that issue?
Yeah, no, we've told investors that we're limiting positions in INFL 5% at cost and then 7.5% at market. So, we'll let those run a little bit within bands within 30, 60, 90 days to correct. But over the long term, those are our limits and we're going to stick by them. And the reason for that is severalfold. So, one is we're trying to provide investors here with a quality real asset portfolio that's going to provide differentiated returns over full cycles. And so, we want to concentrate. It's a 44 stock portfolio. So, by some standards, that's pretty concentrated. But and that will allow our stock picking to drive investment returns without being overly dependent on one sector, one industry, or one company. And so we think that this provides a much more, a very eloquent solution for people that are either looking to supplement or diversify their S&P exposure, their MSCI ACWI exposure, or look at better risk adjusted ways to play things like real assets or nominal yields. And that basically requires some degree of diversification. Although, again, we believe that our levels of diversification still will allow our stock picking and alpha to shine through in terms of the return profile.
Is there any demand from investors or from you and people at Horizon Kinetics to start a fund that is more concentrated? And talk about your other products. I know you have separately managed accounts, but I mean, would Horizon Kinetics ever launch a hedge fund, a pooled vehicle?
Yeah, so we have very concentrated hedge funds. Some of them own a lot of the same things that we own in our other funds, but then have some interesting things that they do on the short side and with leverage. Murray, I think two things that he's been known for. One is Texas Pacific. The other is he was very early in identifying Bitcoin as an investment opportunity, and so both of those make him look quite brilliant this year. And so we also have products around that. Plenty of SMAs. Some are more concentrated than others. And so we have a lot of things for a lot of different people. Another really interesting thing that we're actually in the process of launching next month is a private royalty vehicle where we're looking to do early and smaller stage private royalties in energy, in precious metals, in base metals, in a lot of these eclectic areas where the discount rates are much higher, the yields are much higher, the optionality is much higher. And so doing that in a private vehicle in an interval structure where we're also going to have some public. So it's going to be a public-private royalty fund vehicle that allows us to access a lot of opportunities that just aren't available in public markets today, because just look at the divergence between small illiquid securities and large liquid securities. There's this huge pool of opportunities of these companies to really help them in years 1 through 5 and earn really outsized returns as they scale. And so that's a really exciting product launch that we're looking to close by December 1st.
So that is investing in private transactions. So 100% of them are not publicly traded?
No, so the base of it will be private royalties, but there will be some public securities that are in the royalty arena that tend to be smaller, less liquid, idiosyncratic. But we're looking at basically an initial lockup of 5 years to do, let's say, 80% private royalties, 20% public, and then interval quarterly liquidity thereafter.
So, James, over the course of this interview, you've been very generous with your time and insights. Got some very in the weeds questions. I want to zoom out, ask some very macro bird's eye questions. The first is, do you think, you have an inflation beneficiaries ETF, so I feel like I got to ask you this question. President Trump was elected in a sweeping Republican victory, and part of his economic vision involves tariffs. Many people say tariffs are inflationary. What do you think?
I think that we need to see what is actually negotiated. So yes, at face value, if you put a tariff on something where there's not an alternative domestic supply, then that's going to be inflationary because chances are that's going to be passed on to the consumer. But if you look at his first administration and you read his book, they both suggest that he uses a lot of these as negotiating tactics. And so I think that we'll have to see as the administration and the cabinet forms and then they take office. But all else equal, inflationaries are definitely supportive of higher price levels.
All right. My final question for you is, I know you read A History of Interest Rates. Fantastic book. You talked about it when we did our interview 3 years ago. Since then, I have read the book as well. It's a great read. For any finance nerds out there, I recommend it. It is a commitment. Where do you think interest rates are headed long term? When we did our interview, the short term rate was at 0. It peaked at the top range for 5.5%. Now it's at 4.75% on the top range again. Where do you think we're headed, short term for the next few years? And any thoughts on the long term, 3, 5, 10 years where interest rates are headed, with the caveat that no one knows and it's inherently, unknowable. But just your thoughts.
Are we talking overnight rates or are we talking 10-year?
Let's talk overnight rates. Fed. Yeah.
Sure. And so, yes, I will echo, nobody knows anything, myself included, and this is somewhat along the lines of a blind guess, but I think let's simplify. The simplification here is that barring something exogenous, we need nominal growth, and one of the components of nominal growth is inflation. And whether you call it that or whether you calculate it differently, you need some sort of nominal way to debase or marginalize the debt. And I think that's why you're going to see pro-nominal growth policies, because you're going to continue to see spending. All that being said, I think that that is going to preclude rates from going to extremely low levels. But because of the growing interest burden that the United States Treasury is facing, I think that they are going to try to get rates as low as they can without seeing any type of consequences. And so, I guess if you're gonna put a gun to my head and say, give me a number, let's say 3-ish%. It's hard to see them getting much lower than that. But imagine an upward sloping curve where it's 3% overnight and a 4.5 10-year. So all these assets that are longer duration and their cap rates and their cost of capital is benchmarked to the 10-year, that are hoping for all these cuts helping their businesses. Well, if the long end stays kind of pegged up where it is today, just because of the shape of the curve, that's going to be a very different environment for profit margins and also valuations. And so, not as straightforward as people think, but I think structurally, again, prices are going to be pegged higher. And so the era of zero rates, barring some sort of financial repression scenario, I think are in the rearview mirror, and firmly so.
So that environment you describe, an upward sloping yield curve, which is a normal sloping curve, 3% on the overnight rate, 4.5, 10, 5% wherever on the 10-year rate. That is normal. People often associate that upward sloping curves are good for banks. I think that is generally true. Of course, there are tons of exceptions. Entirely absent are banks. Maybe some of the financial companies, they obviously do business with banks, but they're no JP Morgan, no Citigroup. Why not? Do you think banks do well during a period of high inflation? And also, very frequently absent, I say, are companies that are accused of politicians of price gouging, which politicians say are inflation beneficiaries, such as Albertsons or Kroger's. Do you agree with those allegations? And then why are those types of companies benefit? I mean, maybe you don't think they are inflation beneficiaries.
Well, regarding the grocers, that's comical. You just need to pick up their 10K and see that they're price takers. Mm-hmm. The food distributors give them their merchandise at a price. They have a fixed margin that they mark it up. So to target a retailer distributor of third-party products is just categorically wrong. So that one's, again, I don't know who put that on their they need to fire some of their political aides if that's what they put onto their briefing. In terms of banks, yes, the core lending business, it is a spread-based business. And so you have your deposit rates, and then there's a spread on what you can basically do in terms of your mortgage lending, your commercial lending, your personal loans. And in most environments where there's a upwardly sloping yield curve, that's very beneficial to the banks, to the insurance companies, any type of institution that is a spread-based bank or a spread-based business. And so going forward, all else equal, that should be beneficial to these banks. And one thing that was implicit, but I want to make explicit about my forward guidance or forward view is central banks have certainly made it clear that there's little, possibly no tolerance for a true recession. And what I mean by that is they have combated every type of economic hardship very aggressively with liquidity. So, and I think this is the scars of 2008 and 2009. So let's go back to 2019, long before the well, not long, but before the pandemic. The repo market was blowing up, and they injected, I think it was $30 billion. It seems like nothing today, but quickly came to the rescue to make sure that that plumbing was working again. Clearly, they did not hesitate, and they went very aggressive in combating COVID, which I think obviously they needed to. Subsequently, no one needed to bail out Silicon Valley Bank, but they came into the rescue very aggressively and bailed that out. In the United Kingdom, you had a liability-driven investing crisis where gilts blew out when Theresa May's budget was released. They bailed that out. Those tell me that Western central banks do not have the capacity for a true recession where there are bankruptcies and insolvencies, at least at the current moment, because of the amount of leverage in the system and the vulnerability of the system. But I think go back to all those fiscal stats that I referenced before. If we're spending 7% fiscal deficit during an economic expansion, and we have a garden variety recession where you start seeing bankruptcies and there's some risk of contagion, what are we going to spend? 15% this time? So again, it seems as though the central banks want to remove part of that left tail. This might be famous last words, but if that is the case, and there's not a capacity for the creative destruction that comes with a true default cycle, then things shift to the right. And I think that that's, again, very supportive of both higher rates and higher prices.
Well, I would say the credit markets certainly agree with you. High yield credit spreads are among the tightest ever. The stock market valuation is very expensive as well. I might say that the Federal Reserve did hike interest rates over 500 basis points during a period of economic volatility, to fight inflation. But Powell at least seemed willing to inflict pain on the economy of America, risk a recession in order to fight inflation. He said so in the 2022 Jackson Hole, basically prepare for pain. I'm paraphrasing, not an exact quote. It just so happened that we did not have a recession, but I think that was kind of luck. And of course, now that we know that we did not have a recession, we obviously will in the future, and we may soon. Who knows? But the reason we didn't have a recession in 2022, it's always easy to diagnose in hindsight. Oh, America had all this fixed rate debt, so the interest rate burden did not increase that much on borrowers. But it's easy to say now. James, it's been an absolute pleasure getting a chance to interview you. I hope we can do this again more frequently than once every 3 years. But people can find your work on, of course, at Horizon Kinetics. And I really so appreciate you sitting down with me. And thank you, everyone, for listening.
Thank you. Just close the door.